India is a country of savers. Most Indians do not invest, but they save in gold and real estate. Today, my guest is Sridhar Sivaram. He is a director of investments at Enam Holdings, one of the oldest Mumbai firms. We are going to talk to him about why Indians do not own financial assets and why only cling to physical assets.
The fact that we haven't generated sustainable long-term returns in many of the investment opportunities is one of the reasons that could come immediately to my mind. That just look at the stock market returns for the last 10 years. We've gone from say 5,300 Nifty to 11,000. That's about 7% return. And you adjust for inflation, you've got hardly any returns there. So I think it's the alternatives that haven't generated that sort of supernormal returns, which makes, I guess, the fact that Indians have stayed away from other forms of investing. So they have looked at more options like real estate or gold. And to be fair, I mean, you have to give credit to the Indian housewife that she's done very well. Gold is possibly the best performing asset class over the last 10 years, 20 years, whichever period you see. So as of now, you have to congratulate the housewife more than many of the financial advisors like us.
But one of the things is that one gentleman was mentioning to me that in India we have had this instinct to every time we have some sort of an income, we buy gold or we buy some physical property, and that has been a tradition in this country for centuries.
Right.
Now, is that something that is part of the gene pool which makes them risk averse and align to physical assets much more?
So I was reading somewhere that India has roughly about say 25,000 tons of gold. I mean, that's possibly 50-60% of our GDP by value. Now, obviously, it is not getting used in a productive manner because it's lying inside some vault or somewhere else. But the point is that that part of the asset has created some value. Eventually, so if you see what is happening to gold loan companies these days, generally that when the requirement is there, people are using some of that gold in use. So whatever has been done, it seems like because of the tradition, because of the culture, there is a inherent attraction towards gold, and to some extent physical assets, which is say real estate. I mean, at this stage, I would only say that given how the returns of some of the other asset classes are, it doesn't seem completely out of place. But yeah, some diversification is there is a merit to that argument also.
So, is there something of a problem with the messaging which is going out from the financial services industry? I mean, is it something they are not doing right, which is not making people appreciate what different financial assets can, bring to everyone's lives?
Yeah, I totally agree on that. I think the messaging is completely wrong. Uh, we tend to push a financial product when that asset class is doing very well, and then we show the previous 3 years or 5 year returns, and we lure the investor in sort of indicating that this is the return that you're going to get, not sort of trying to warn that there are a lot of risks involved. Having said that, I would say that Amphi has done a very good job of educating people as far as mutual fund industry is concerned by the entire mutual fund Sahi Hai campaign that they have run, which has sort of educated people, and we are seeing the type of systematic investment plans that we are getting on a monthly basis. I think we've done it very late in the cycle. So it's only now that we are in closer to 2000 per capita as a country that we are seeing some inflows into equity and some inflows into mutual funds. But as people would say, better late than never. But I think we've started now. Having said that, I will also say that mis-selling continues. specifically in the insurance industry, where you hardly sell protection and you're selling savings product again there, and as a result, every 5 years you see a debacle in the insurance industry. I think the mutual fund industry has improved significantly in the last 5 years, I would say, in terms of how they are selling. And I think investors have broadly understood. So I think it's a gradual process, but I think we started the process.
Also, one of the things is how Indians in general seek financial advice. It typically begins with some friendly LIC agent, or somebody who sells insurance to you, try
Right.
to convince you of investing. At an early stage when you're working, there is some uncle in the family,
Yeah. Yeah.
somebody within the family or friend who starts to give you some sort of a advice of saving money, the importance of saving money and putting it into what used to be called earlier money back policies. And
Yeah.
insurance
Yeah.
is something that becomes the first thing that middle class gets access to.
Right.
Now this particular thing continues even today. I mean, like you touched upon the mis-selling aspect.
Yeah.
uh,
Yeah.
uh, is it a collective sort of a failure of the financial services industry, or it's like a combination of multiple factors of per capita income plus people wanting to take risks, plus the fact that there hasn't been any significant push given to correct propagation.
Yeah, yeah. So I would say financial products largely are push products because most people don't know where to invest. I mean, they know they want to invest, but they don't know where to invest. So it's actually a push product. Unfortunately, that push comes from financial advisors, and they look at more what is good for them rather than what is good for the investor. So as a result, there's a friction which comes up after a few years, not immediately, but after a few years, the investor realizes that, hey, I didn't get anything. And then he figures out that, hey, he made so much money. So I think the whole thing is that the transparency is very poor. I would want to admit that both SEBI and RDA are doing a lot to improve the transparency. I mean, we've seen a lot change, and even in the insurance regulation, I would love to see more happening there, especially given the huge first year commissions that are paid. And also in the mutual fund industry, where a lot of commissions have been rationalized, expenses have been reduced, and I think more can be done. But given the inherent nature that's a push product, then the advisor typically tends to look at himself first and the investor second. I think the day when it changes the other way around, I think the trust factor will build in. And even if there is a risk factor in the investment and it comes through, the investor then understands it much better than what is today. There's always a hard feeling here that somewhere the consultant has cheated you.
There is also, recently effort being made to separate financial advice from distribution. Now, is that something you think that is needed and should be aggressively implemented? Where if you are advising people, you should not be selling them.
No, see, I think what happens in the quest to move to a perfect investor protection sort of environment, regulator tends to go to the other extreme. I mean, we haven't yet developed or reached that stage where we can segregate between advisor and a distributor. I don't think the investor is prepared enough to pay for advisory. So if you go and tell an investor that I'm going to charge you 1% or 50 basis points as my commission, and I'm being upfront about it, and then I'll advise you XYZ, I don't think it works in the Indian scenario, at least not today. So I think we are being too early in trying to put all these, classical models which have worked in the West, where the per capita is $25,000. So I think it's too early. I don't think it works. I think we need to take baby steps. This is like going to the other extreme. That's my personal view that it doesn't work.
You also mentioned about the systematic investment plans and
Yeah.
how they are increasing
Yeah.
each month, and we have increasing participation from individual investors. Now,
Yes.
one of the things about them is that in a large part of the initiation into SIPs is happening into diversified equity funds.
Right.
Now, one of the area which is not pushed by manufacturers of products like mutual funds is index funds or
Right.
exchange traded funds. Now,
Right.
obviously, there is an issue of compensation which is given to
Yeah.
them, or
Yeah.
fund management fees that are
Yeah.
involved over there. But from the retail investors, ordinary
Yeah.
person standpoint,
Yeah.
I think what happened in America, you think can be replicated in a market like India through index investing, isn't it?
Yeah, so I think, as I said in the earlier context, that financial advisors are looking at themselves first and the investors secondary. And if you look at the last 3 year average performance of mutual funds, I think not even 10% have outperformed the benchmark. So the fact that we are seeing more discussions about ETFs today is because we've crossed the phase where outperforming the benchmark was very easy, and we are entering a phase globally. Also, it's very difficult to generate 500 and 600 basis points of alpha every year over year. I mean, the generation of alpha is a much more muted 200, 300 basis points. That too, if you're extremely smart and lucky. So I think that is a phase which will come back to India. And what has happened globally about ETFs will come in India also. And investors will realize that in the ETF, I'm paying 15 or 20 basis points. Paying 120 basis points expenses in a normal diversified fund. It will change. But as long as more assets come into the industry, I think the industry should be still happy. That's my broad view. That as long as you're getting more money into the industry, it should be good. And whoever pushes this product will possibly hold it for much longer than many of the diversified fund SIP products which we are seeing today.
Yeah. So that essentially, brings us also to the issue of what lies ahead and what kind of a future we are seeing from an investor's standpoint.
Right.
The first is important aspect is disruption.
Right.
Kind of disruption you foresee in the process of investing as a result of, say, the development of the blockchain technology or artificial intelligence, or machine learning? How
Right.
do you think Indian investors, have been lucky earlier in the telecom cycle to sort of leapfrog the,
Yeah.
landline revolution? Do you
Yeah.
think something like that can happen in India in case of investing? That Indian investors may just leapfrog past experiences of retail participation elsewhere in the world?
Yeah, so to start with, investing itself is going to see a significant change. I mean, if I go back to traditional investing in the past, you used to buy good companies and sleep, and you didn't have to do anything. I'm talking from a fund manager standpoint now. And that has or will significantly change exactly for the reasons that you mentioned. All the disruptions that we are seeing, and you don't know which company is getting disrupted because of some new technology that has come. Nobody is safe, so you have to be alert as a fund manager. And same for the investor, that he cannot just sit on a investment and assume that it will give me that 10, 12, or 15% CAGR over 10 years. That may or may not happen. So that's the first. And secondly, as far as ease of investing is concerned for the investor, I think it will only change. We've seen already during this pandemic that retail investors are almost 75% of the daily traded volume, or non-institutional investors are 75% of the daily traded volume. Now that has happened because of ease of investing. You have many of these apps where you have zero commissions and you can just press a button and you're trading. I think these will increase even better. And today you can even sit in your house and trade in the US markets, in the UK markets, or any other global markets, in commodities, gold, everything you can trade. I think these sort of options were not available, say, even 5 years back, or were available to very few. Today, it's becoming a mass product. I mean, almost every security house that I know of is now starting an option where you can trade on the US markets, sitting here without even having a US account. So I think these changes will happen. I think investing will become very global, and markets will also, they're already very global. I think the correlation of global markets to what happens to one market to the other will only increase. As a result, the volatility will also go up. So I think the whole paradigm is going to shift.
So, what does it really mean for, say, retail products of that are available for investments? Do you
Right.
think we'll continue to have the same mutual funds, same avenues of products, or there would be a significant change in them? For example, people are talking about something called, tokenization. So it's like crypto assets. So you can actually, an ordinary investor can own a piece of art which otherwise was only available to the rich guy. So,
Right. Right.
do you foresee some change in the way ordinary people look at owning different kinds of assets if there is greater transparency because of technology?
So I think to start with, financial advisors, I don't think are today advising properly as far as asset allocation itself is concerned. As I said, this is a push product, so you're not even advising people on what is the correct asset allocation, because most cases the advice comes based on what is the commission that they get. So you end up owning products in your portfolio where the advisor has the maximum commission. I'm giving you a broad framework. Obviously there are good advisors who don't do this, but that's a broad framework. So would asset would advisors go and tell any client that you should have at least 5 or 10% in gold, or you should have maybe 5 or 10% in some other asset classes like cryptocurrency you mentioned? I don't think those are being pushed today. So what it is that the investor on his own, if he has it, it's great. Otherwise, he ends up with the same: have some fixed deposit, have some mutual fund in equity, have some debt, and that's about it. And he doesn't have an idea as to what percentage he should have and what percentage he should be as his age progresses, because there is a science to that you don't want to be very high in equity as your age progresses. So I think those are sophistications which we haven't developed. I think it will come. We are $2,000 per capita, as I said. So eventually these sophistications will come over a period.
So, but sophistication in markets is one aspect. But really speaking, if you look at retail investors, what they understand is, here is my money. I want my money to grow like this over the next 5, 10, 15 years. I
Yeah,
don't want
yeah,
to. I don't want to go and dive deeper into it because, see, I may not be a finance professional,
yeah,
but
yeah,
I want
yeah,
to understand how, as an individual, you should be looking at when to enter the market and when to exit.
yeah, yeah,
So,
yeah.
so the retail investor may not understand that sophistication that we talk at the back end, but
Yeah, but
to,
that is the advice that the advisor has to give. That there is no a single bullet or an investment which suddenly doubles your money guaranteed in even 5 years time. There is nothing. I mean, you have to ride the asset class, and over a period, you make that money. Unfortunately, a lot of investors think that if you come to the stock market, you can double your money in 1 month. That's not the case, and you end up burning your finger. So I think it's a question of patience, and to possibly educate the investor that with patience and with a period of time that you allow the investment to stay there, that's how you make money. Overnight, it just doesn't happen. You and me have seen this market for many years.
absolutely. And just before we wind up, I think one of the things is that people simply understand gold and property much better than any other sophisticated financial product. I think it's the level of understanding which kind of makes the whole difference, isn't it?
Yeah, so I think Indians have been used to physical assets and they understand that very well. But having seen that, I'm just saying that the physical assets also is now available in a tradable format. I mean, gold is a classical example. You have ETFs in gold, silver, and any of the other precious metals. You have REITs for real estate. So you don't need to actually physically own the real estate. As you mentioned, I can own a part of the real estate and still ride the real estate wave that I want. So I think the sophistication in the investing is improving. And as the investor understands that owning a physical real estate is so much of an hassle because he has to maintain the real estate. He has to, look at what is happening to the rentals and stuff like that. He can just ride the wave on a platform which gives him that option, which is a REIT or an ETF for a gold. So I think those investing styles will change over a period.
All right. I think we are pretty much running out of time. Thank you so much,
Thank you,
Sridhar,
Rajesh. Thank you,
for
Rajesh.
being with
Yeah, thank
us.
you.
Thank
Bye.
you.